Do you think it perhaps changes your thinking in any way, or the revisions matter more?
I mean, a little bit of both. I think the Fed Chair Powell says he subtracts 65,000 a month from any jobs report because he knows the revisions are negative. Yeah. But I think that it's not lost on the Fed that AI is sort of wreaking havoc across software now. And that means that jobs losses are soon to follow. So I think the stock market isn't going to care about the labor reports in their minds, because in the back of their minds they're going to say, well, how much of these are going to be lost in the future due to AI?
Do you think Kevin Warsh and his Fed would care more about what AI is doing to the jobs picture and how inflation is sort of behaving at the moment? What are your expectations? Because at the start, right upon the announcement of his nomination, market was acting like he's a hawk.
Correct.
You don't agree with that market reaction?
Yeah, I mean, I think the market reaction, and I think they're rethinking it, didn't make sense because Trump wouldn't appoint a hawk. But it looks like the new Fed, Warsh, actually does want low rates but a smaller balance sheet. But to me, in 2026, the overarching story is that if jobs are shrinking and AI is wreaking havoc across sectors. Remember, software used to eat the world, right? It's a $450 billion sector. Now that's getting eaten by AI. If software shrinks, that's deflation. So I think the inflation picture, and AI is showing it's actually disinflationary. And we get a CPI report in January from this Friday, but core CPI year over year might drop to 2.52. That's the average from 2017 to 2019. We're back to pre-COVID inflation. So I think we have a dovish Fed coming, and then Fed funds rates were like 1.5, 2.0 back then. So I think there's a lot of room to cut rates. So I think it's a disinflationary environment.
And when the Fed stays dovish for those reasons that you were just laying out, and even go for a couple of cuts later this year, does the market react to that positively? Because it matters why. If AI is eating jobs and AI is affecting software in a negative way, is that a good thing for the markets?
Yeah, it is. But it's creating winners and losers. That's what the stock market's trying to figure out. Last year, they were buying the Mag 7. Those are like the armies. This year, people are buying energy, industrials, commodities, power generation, chips. Those are the bullet makers. So they're still buying AI, but they're buying the guys that receive the CapEx. I think software may be a net loser, but they're a distributional consequence of AI.
I know that your outlook for this year is that we're going to do okay in the first half, and then there could be some bear market like a drawdown and then pick back up. So number one, are you sticking to that outlook?
Yes.
And number two, when that does happen on the U.S. market, how does that affect international markets? I feel like you're spending more time paying attention to what's going on international markets. Does that have a sort of simple spillover effect to the rest of the world and to Asia, or does international outperform the U.S. again in 2026?
I think there's a scenario where the drawdown, we think it's a three-phase market. So let's say we get into the period where the U.S. stock market declines 10, 15, or 20%. A lot of that is probably rotation out of Mag 7. So out of the armies and plowing into industrial financials, everything else. But Mag 7 is 55% of the market, right? That's a big complex. That's probably bullish for non-U.S. because non-U.S. country indices are industrials, materials, everything but tech. So I think it actually is bullish for non-U.S.
Yeah, and speaking of gold, Tom, a lot of crypto bros, sisters, people, I mean, even at Consensus, it felt quiet. Maybe it's really the crypto headlines that I've been reading about. And in the event yesterday, it just felt more contained and quiet. Perhaps it's really the FOMO over gold and really disappointing price action in crypto space. So my first question, your end of January calls for Bitcoin and Ethereum, they were pretty bullish, but it didn't really materialize.
No.
What were you looking at? What were some of the factors that you thought would drive up Bitcoin and Ethereum by the end of January? Why January?
Crypto had a price shock in October, and that was, in terms of deleveraging, bigger than November 2022 when FTX failed. That was, in 2022, the bottom for crypto. Crypto was beginning to recover from that carnage because it takes about 6 to 8 weeks. And historically, crypto recoveries are V-shaped. But I think a couple things happened that really hurt us in January. Number one was, in October 10th, we had a tweet about China that over the weekend caused huge ripple effects. Well, we had a Greenland tweet that triggered another cascade of liquidations. So crypto basically got chopped at the knees again. The second is that crypto investors have been frustrated. As you correctly point out, Consensus in Hong Kong, the mood is horrible because past crypto winters, which are bear markets, happen when the stock market's declining. So people don't feel bad about like, oh, I'm stuck in crypto, but like everything stinks. But actually stocks have been okay and gold has been really good. So now people have like this egg on their face saying, am I a dunce for staying in crypto when I could have just been buying gold? Well, that is playing into the psychology because gold started to do really well in January. So I think FOMO plus the fact that there's now double negative leverage effects because of Greenland means crypto is, it looks really like it's bottoming because the fundamental story of crypto is quite positive.
Hey, man, red across the board. And this is an important video because I'm going to show you some charts here that are just mind-boggling to me in a way. But when you look at this, I mean, it was everything and take it to woodshed. Were there stocks that hit 52-week highs and new all-time? Yes, they're out there, okay? But pretty much every sector was getting hit today except for what? Not the heaviest, but a lot of the consumer staples, healthcare stocks, things like that were doing pretty well. And I hadn't even looked at this sector. Man, this is quantum computing. Whoo, I hadn't looked at this in so long. Oh my goodness. Ugh, I mean, just massacred. And it goes back to a couple of Saturday videos when people kept asking about these stocks and the other stocks, and I kept saying, boy, it's great they're working, but trust me, when you ain't got no income and things get rough, they're the first to go. They get thrown out with the bathwater, and boy, they get thrown out with the bathwater. Man, I don't know where the bottom is on it, but whoo, this right here. Oh, 7.77% from the top. It set a new all-time high and then just went, but it bounced off this trend line. What did it come into? Daily imbalance, trend line right there. Guarantee you this is a nice discount. Okay, yep, 0.79 fib lines up perfectly. So great bounce right there. And if you want to pull it all the way down, you can. I mean, that don't matter to me, but great bounce. And it got such a big bounce, it's like a 2% bounce. But I mean, the sell-off was huge. Okay, so, but it had been doing what? It had been going up like every day. New all-time high, new all-time high, new all-time high, which is, you know, interesting because it's crazy about it. If you think there's going to be a slowdown in the economy, like, you know, why are airline stocks going through the roof? Why are these other stocks going through the roof? But they are, you know, which kind of contradicted what a lot of people are trying to say. You know, look at Dow Jones. I mean, this one right here. So here's your industrials and things like that. Big drop, 2.19% from the top right there. Came down to discount, came down to this imbalance. Tried to hold on. I think it actually ended today at its low at the very last 30 minutes. RSP set a new all-time high in the morning. Sold off 2.5%, which is a big move down for this one. But I can see it. I didn't put the trend line on here, but I can see the trend line right there. And so, you know, this one's coming down to this imbalance. That's where it bounced at. And the discount, all this stuff, they've been going up. You know, it seems like every day I've been saying, going all-time high. Look at this right here. And we'll talk about where the money actually went or didn't go. And one thing to watch out for on all of these charts is this right here. If we come up and do this right here, are we going to do that? Which, because you can see, right? Boom, boom, boom. And then all of a sudden, nope, here we go. Coming down, right? They all of a sudden, gravity takes effect on what's been working, okay? Or are we just going to do this right here? It's just profit taking coming down, time to keep working, okay? And you look at S&P. What's the S&P doing? I mean, this thing has been in the same range for like 3 or 4 months. I mean, not doing anything. There's no correction here. Are you kidding me? And what people don't realize, you're trying to figure this out, is like, is this accumulation for maybe one more push higher because we are late in the cycle? Or, you know, is this going to be distribution? And you're finally going to see a nice push to the downside. I mean, that's what you're trying to figure out. Everybody's trying to guess, you know, which way and that and the other. You know, look at the Qs. They've been bad. Like I said, it's not down massively, and it still has not broken this anchor VWAP or been able to hold below it, I guess I say. Haven't been able to close below this anchor VWAP. If that happens, I think you finally do get a shot coming down first of that shaded area, and we'll take it one level at a time. And, you know, and we'll take out the November week low and all that fun stuff. But I think there's something that has to happen first in order for, you know, to see that. Could be wrong, but we'll see. You know, and the question is this right here. You know, we came down this box, we talked about it last night. If we broke 6906, really, you're going to see that. And so that's what happened, right? Came down, bounced off 0.79 fib, and you can clearly see below is what, 6,800, somewhere in there. So here's the deal. We got CPI tomorrow, and so if the market doesn't love it, we're going to break 6,800, okay? If it does love it, and I'm going to pull up the SPY so we can actually see these numbers a little better. So let's say this. Let's say we'll take out this box. It doesn't love it, doesn't accept it very well. We're going to come down here. We're going to end up challenging probably 676 right there. If it loves it, we're going to come back up to 690. That's a big move, by the way, but it's going to be some crazy like that, okay? If it loves it. So we've seen this many times. We all of a sudden get this move down and just crazy rip your face off rally because of some news we got and everything else. And so you're like, okay, is this going to be a repeat? Is this what's going to happen? And so I'm not going to be surprised. I think there's going to be a move in the overnight market. And then, of course, CPI is going to hit 8:30 in the morning. And then we're going to see if we get to push down and eventually have a reversal to come back up, or a big push up and it just rips your face off. And everybody's like, wait a minute, I got to short it. And that doesn't work, okay? And the one thing to look out for in all of this is this right here. Everybody thinks it's been rough. Usually the second week of February is supposed to be the roughest when it comes down to this, not the first couple weeks. And so we're entering into the next 2 weeks. And what's a major catalyst that's either going to cause this? And I'm not sure if we're going to run up into it or run down into its bigger question, but it's NVIDIA earnings. I mean, that's the next big shoe to drop. You have seen what's happened on these Mag 7 moves. I mean, they've been enormous. And NVIDIA does not have a great reputation for running up after earnings. You can see right here, 13% drop on the previous one. You can see right here, that's around a 13% drop as well. And then we go to the one before that. This one we actually ran, this is the only one of the last 6 where we actually ran it. We went on a big heater here. Okay, this was May through August. So those are bullish months going into June, July, August, right? And then, of course, this right here, we end up running down a whole lot more than 13%. But the initial was, I mean, overall 35%. That was terrible. The one before that, you can clearly see that is not going up. And so the initial moves around 13%, 13 seems to be the magic number, came back up, went down a total of 24, and then you come over to the left again. Again, these aren't crash years. This is just 2025. I mean, you had a great year in 2025. You go the one before that, I mean, down, 20% right there. So, and you go back and go, well, that was up. Cool, we went up there, went up here. Go back to 2024. That one was a down one as well. So if you consider those three, that's going to be 3 out of 9. So not a great track record, right? And where's that? It's at this level for whatever reason. Every time we hit it, we can't break through it, right? I mean, we have rejected on this thing so many times now. And when I get the little circle out here, it's 1, 2, 3, 4 rejections, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 rejections right there at that level. Eventually, you think, okay, so that's the big question is, are we going to continue to run down going into NVIDIA earning, which of course would give it a much better shot of moving back up? And so that's just a bigger question. I don't have the answer for you. I wish I did. But I will say this before I forget. I was looking to see when we had a big sell-off and the things that were working, like transportation and all those, would any money rotate over into tech, software, all the things are just getting hammered down.
Undoubtedly better than expected jobs report. Yields ticked up, maybe expectations of cuts by the Fed ticked down. We're trying to just figure it all out today?
Yes, I think the macro is a little confusing for investors at the moment because we not only have a new Fed chair that's announced and his policy stance isn't clear, but I think investors have been thinking AI was going to eat the jobs market, but we have a pretty decent jobs report. I think it's going to put a lot of weight, and we of course had a weak retail sales, but it's going to put a lot of weight on Friday's CPI report because if that comes in tame, at least the market can understand that the inflation part of the Fed's equation is cooling. And of course, now if the job market is showing decent strength, it kind of relieves us from a macro perspective because at least we're not seeing an economic downturn.
How about the fact that the market's been a little frazzled? That's the word I've been using today lately. Bespoke points it out. For the first time in history, the S&P went from overbought to oversold back to overbought in a week or less. Goldman's Tony Pasquarello, Tom, says he can't recall a time that was this noisy, this high velocity, this wide open. What about you?
It's very confusing, Scott. I think that there's two things happening, but I think one is really the bigger effect. I think the smaller effect is that AI, as you know, has gone from being this sort of driver of S&P earnings. Now the market questioning, is AI just wrecking tech so badly that it's bad for the stock market? And also, they're not buying the data centers and hyperscalers anymore. They're actually trying to buy the bullets, not the armies. But I think the bigger effect is that gold has become like this singular monolithic trade that's worked. But gold now is a $40 trillion market. X the Mag 7, the S&P's $40 trillion. Gold is now bigger than the stock market. So I think as gold rises, I think investors are wondering, do they really want to use stocks as a store of value if they can just be buying gold?
Man, I just feel like we're kind of going down the line of the AI shooting gallery. And first you take down some of the mega caps, and then you take down a lot of software, and then you take down some of the private credit names, and then you take down some of the financial data related names. Is that just how it's going to be? We're just trying to guess on who's going to be disrupted the most?
Well, I do think AI's capabilities, Scott, are showing improvements, maybe, as they say, doubling every 7 months, and now it's going from mediocre to quite good and substituting some jobs. I think that, of course, is rattling markets. But at the end of the day, and this is a half-full perspective, it's kind of proof of productivity. So to me, I think what we're seeing is that there is a payoff coming from AI because for software companies, for the ones that are actually truly disrupted by AI, that actually is a cost savings for a client. So I think it ultimately is productivity.
Tom, when someone like David Einhorn comes on today and says, quote, I think this is the most expensive market that we've been in, can you argue with that? I mean, you could say that it's pricey. Others would say, well, it's justified because look at how earnings are beating expectations. How do you parse that out?
Well, I mean, on a relative basis, his statement is correct because, as the late Art Cashin said, bull markets don't die of old age. They get murdered by the Fed. So every year, the market does get a little more relatively expensive, even if earnings are good. But this year is pretty unique. Earnings growth is accelerating. The ISM is back above 50 after spending basically 3 years below 50. We have a new Fed that ultimately, I think the market is concluding is dovish, and David Einhorn actually believes he's dovish. So that's supportive of multiples going up at a time when the stock market has been shown 6 black swans, from all the way from COVID to the tariff disruptions, and still grew earnings. So I think the market's going to have to start to give a higher PE to the equity market, just in the same way that gold's being re-rated at the moment. Gold's PE multiple, price to sales, I think is over 50 times right now. So if gold can re-rate, I think equities can re-rate higher.